With the SEC in the US declaring that all cryptocurrencies except Bitcoin are securities, it's a good time to ask ourselves what these famous utility tokens are that so many projects claim to have in order to fund their project by issuing a cryptocurrency. To put it simply, what is the difference between Bitcoin, Aave, Binance's BNB, Swissborg's CHSB, or Illuvium's ILV token? Let's start with the reference, Bitcoin, because all these examples share the desire to present themselves as more or less decentralized tokens. On this criterion, Bitcoin is the most decentralized because its entire organization is spontaneous. No one asks miners to mine, coders to code, or certain users to run nodes. This spontaneous organization makes Bitcoin elusive on paper. That's why the SEC and the CFTC, the US market regulators, have declared Bitcoin to be a commodity, giving it a regulatory status comparable to gold. We can even say that Bitcoin is a reference DAO. This term DAO, which stands for Decentralized Autonomous Organization, means quite simply that the authorities could hang any member upside down and shake them as long as they want, and it wouldn't change anything in the network because no identifiable individual has enough power to change the current rules on the network without going through consensus or an absolute majority. A DAO is by essence an anarchic organization that follows rules issued by an inviolable consensus. Even Bitcoin could potentially be compromised by states. However, to pull off such an attack, they would first need to gain control over the network consensus as dictated by the rules of the system. In practical terms, they would have to succeed in gaining control, and then the attackers would have a substantial power over the protocol to do as they please. But it's worth noting that with Bitcoin, this is a challenging task because they would have to operate within the rules of the network with millions of users. Wrapping up on Bitcoin, it's important to note that the rules of the protocol's DAO are embedded right within its own code. As for the Bitcoin token, we can think of it as the utility token of the Bitcoin network. There's simply no way to interact with the Bitcoin blockchain without acquiring some Bitcoin tokens. So we refer to utility tokens when a cryptocurrency is decentralized. If, on the other hand, your token is issued by a distinct identifiable entity, like a company, then financial market regulators identify you as the issuer of a financial security that needs to comply with certain regulations. These tokens are then called security tokens. To simplify, a token is classified as a security token if there's a known user and the token functions to establish a financial agreement between the issuer and the user. Take, for example, based on recent comments by Gary Gensler, a token like Swissborg's CHSB, which was issued by the company during the ICO that concluded on January 10th, 2018, would fit into this category. This is because the CHSB token becomes obsolete if the Swissborg company were to cease to exist. There's in fact an investment contract between CHSB holders and Swissborg, as the sole utility of this token is to attain financial benefits on the Swissborg platform or its affiliated subsidiaries. An investment contract is defined by US regulators. So how do we define if we are offering an investment contract to the public? Well, we apply the Howey test. Generally speaking, if we can mail a registered letter to the token issuer and the token has financial utilities, especially if those utilities are tied to the issuing company, then we're dealing with an investment contract. Take Binance, for example. They're attempting to be shrewd by creating the Binance Smart Chain, suggesting that BNB is a native token of the Binance Smart Chain, which is ultimately run by Binance. Its main utilities are fee reductions within the Binance ecosystem. So, based on my understanding of investment contracts, BNB in fact falls into this category. When I buy BNB, I'm essentially speculating on the success of Binance and aiming to increase the value of my token on the Binance platform. Now at this point, I'm not passing judgment on whether this is good or bad. I'm merely saying that from a regulatory perspective, such strategies to evade financial security regulations aren't likely to last. The key question about these tokens, and this is why we don't speak of them positively on GA Crypto, is this. If one day a regulator like the SEC terminates these tokens, what happens to the people who own them? Well, if we consider the case of the library token from the Odyssey platform, which faced an SEC lawsuit, the answer is you lose everything. Since you bought something that has no legal standing, the company goes bankrupt, and you have no means to reclaim anything from anyone. This is because you simply bought something that should never have existed. Now let's focus on the case of Aave, which is a decentralized lending and borrowing platform. Initially, the Aave token, AAVE, was issued by Aave Company, which still holds a significant amount of it. So once again, we're dealing with a financial contract. However, here's the key difference. If the Aave Company were to go bankrupt by a court decision, the Aave protocol would continue to function, and the token will retain its utility because the Aave Company is no longer the primary contributor to the project. Aave did raise funds for the Aave token, and they still hold a portion of it. But since Aave is a decentralized protocol, whether the company is guilty or not, it wouldn't affect the protocol and its users. The same goes for Satoshi Nakamoto, the creator of Bitcoin. who disappeared after the first presentation of Bitcoin to the FBI. Bitcoin no longer needed him, and for his own security, it was a wise decision for him to disappear, especially at a time when Bitcoin was an anomaly in the world of finance and markets. So, could this be the key to utility tokens? Not just a decentralization of the token itself, but the decentralization of the service in the form of a protocol on a blockchain. Assuming Ethereum is sufficiently decentralized to withstand an attack from the Ethereum Foundation, which is possible, but we won't know until it's been tried, unfortunately for them. This brings us back to the choice of anonymity and the disappearance of Satoshi Nakamoto. At this stage, we can distinguish between two types of projects. Those that are genuinely decentralized, and currently the US regulator only recognizes Bitcoin, but there are other strong candidates on the list, such as Ethereum or Aave. And then there's the false security tokens, whose future is potentially bleak if the US takes action and if the European Union joins in this battle. That's why in the case of CleanSat mining, we chose to issue security tokens. It's expensive and time-consuming, but at least we have a well-defined framework. So, to sum up, a token can change its status. Initially, it's considered a security token because we know its founders, but over time, it can become a commodity when it reaches a sufficient level of decentralization. But is this the end of the story? Does innovation in ways to transfer value on the internet stop here? Well, no. A paper from Harvard proposes to see things differently by considering that the famous investment contract does not concern the token itself, but rather the financial proposition. For example, instead of questioning at what point the Ethereum network became decentralized enough to consider Ether as a commodity, this paper suggests considering the issuance of Ether by the Ethereum Foundation as a financial contract governed by securities laws. However, when two unknown individuals exchange Ether on a secondary market, whether decentralized like Paraswap or centralized like Kraken, they fall outside the scope of the securities laws. This approach is interesting as it eliminates the need to speculate on the degree of decentralization reached by a cryptocurrency to determine if it's a security or not. So in the case of Aave, there is no problem because the Aave company does not offer any financial contracts to its users. The Aave protocol makes a decision. Therefore, it works because Aave today belongs to all Aave token holders and to no one in particular. However, this approach does not completely solve the problem for Binance or Swissborg. When trading tokens on secondary markets may not pose issues according to this new line of thinking, we can question all the rewards provided by BNB or CHSB that directly result from the responsibility of these companies. It doesn't seem straightforward in principle. This is where I refer to another model, that of the game of Illuvium, which is a metaverse. I find the principle interesting, although I can't say for certain if the promises are real or merely superficial, as I don't have sufficient knowledge about the project at that level of detail. In principle, they separate the game from the token. One DAO manages the token, while another manages the production of the game. This is interesting because producing a game cannot be fully decentralized as it involves an artistic team and an entrepreneur. Let's move forward. In principle, at the time of issuance, it's considered a security. Okay, then the token circulates as it's resold. That makes sense too. However, this token, even if it's in a DAO, is exclusively created to raise funds to develop the game in question. And as a result, its use is exclusively within the game. For example, when you sell in-game items on the secondary market, a portion of the fees is captured by the DAO, which aims to, in one way or another, contribute to the game. And assuming the DAO is indeed real, that's where it becomes intellectually complicated. If we want this kind of approach to work, it's clear that we need to find a balance of power between the governance of the economy and the governance of the enterprise. It's a fascinating subject, but to be honest, I don't think we've found the recipe just yet. Today, I want to wrap up with the fact that new models in the crypto space are evolving in parallel with regulations, or at least based on what projects understand about the intentions of regulators, and a sort of dialogue through experience is emerging. This also puts marketplaces at the center of these considerations, because one can argue that a crypto exchange on Binance is a financial contract since Binance is a company that profits from it, whereas on a decentralized exchange based on pools, it may not be. That's why with regards to GA crypto, we focus on decentralized protocols. Beyond these legal considerations, let's not forget that the major benefit of crypto is to personally hold and manage your financial assets without intermediaries. Personally, I believe that the custodian model, where you trust an intermediary to hold your assets, has widely proven to be a failure on a large scale in far too many cases. In any case, what is certain is that at least 99% of projects claiming to be decentralized are in fact not truly decentralized, and a significant portion of them are scams or poorly executed projects. So definitely proceed with caution.